Good morning. I'd like to open up the Pension Committee meeting, and at this time I'm going to turn it over to Tim and Jim from Alesco.
Morning, guys.
Good morning. Happy New Year. Good to see you. And I'll make a few comments, and then Tim's going to get into the numbers. Before I do that, though, how much time do you have allotted for our presentation this morning?
30 minutes.
Okay, terrific. Thank you for that. As you all know, this has been an interesting year. 2020 was an interesting year from a variety of perspectives. We're here to talk to you about the climate for the capital markets, and it was a year in which there was a great deal of volatility in the market, but it was also a year that reinforced some of the tried and true approaches for long-term investment management. Specifically, having a disciplined asset allocation and maintaining that asset allocation through thick and thin. You know, the thick parts are easy when the markets are going up and everything is favorable. But when the tide turns, which it inevitably does, and with far greater frequency than we have a tendency to remember, it's very important to maintain that discipline. So we talk about a pension plan, and where we have these long-term liabilities that need to be funded, and it allows us, because we have a longer-term investment horizon, to take more risk. And as you'll recall, when we started working with you at the beginning of last year, actually the very first day of 2020, we had recommended to you, and you were smart enough and wise enough to take our recommendation and increase the equity allocation, which we did really pretty much around the bottom of the market, and that has helped your returns. So the change, moving to a more aggressive equity allocation, the wisdom of this group and its willingness to maintain its course, the direction you've given us, has served you very well, as Tim is going to share with you in a minute with results. We thank you for that. We thank you, of course, for your business, and Tim's going to go through the presentation. We'll each pause from time to time to see if there are any questions, or if there's something that you want to interject right away, just speak up, and hopefully we'll be able to hear you. So go ahead, Tim.
Great. I think I'm able to share the screen, my screen here. I'm going to try to do that here. Yes, I'm able to see it here. I'm trying to find the right. All right, so you see that. Everyone able to see this as I move to the performance pages? Can everyone see that? Is that visible?
Yep, you're good. Yep.
Okay, great. Thank you. So we'll start off taking a look at the overall asset allocation of the non-salary DB plan. You can see just my screen here. There we go. So you can see that the equity allocation is at 66%, well within the range of the investment policy. There's a little bit of cash in the portfolio. Fixed income at 25.6, about the middle of the range, and the real return assets, which are TIPS, are at 6.4%. So everything's within the ranges of the investment policy. Moving to the equity allocation on page 2 for the non-salary DB plan, 48% of the equity holdings are in large cap stocks. Those have been the leaders over the last couple of years, and one of the things that we'll highlight for you is the very strong market rotation that we've seen to asset classes outside of large cap. And that's roughly half of the portfolio for the Centro pension assets. Large cap value at about 4%. Down the capitalization spectrum to mid and small cap is roughly 18%, and then international stocks at about 30% of the pension plan asset. So very broadly diversified portfolio, and being able to take advantage of the shifting dynamics within the capital markets, which we'll talk about as we move along. On the fixed income side, about 10% of the portfolio is in floating rate investment grade corporate bonds, the rest in the broad bond market. And we're holding the duration of the portfolio a little bit lower than the overall market, so taking on a little bit less risk than the bond market, just with the expectation that yields are likely to move a little bit higher this year, and especially on the long end, only on the long end of the curve. The Federal Reserve is not likely to raise interest rates for a considerable period of time, but the long end of the yield curve, as the economy picks up, is likely to go up a little bit this year. So we do have a slightly shortened duration to the overall bond market in this portfolio as a bit of a protection against that. Any questions about the asset allocation? So taking a look at performance on page 4 for the non-salaried plan, we've got the 2 time periods, fourth quarter and then the inception, which is effectively 2020 performance since we started working with you at the beginning of the year. So at the end of the fourth quarter, the pension plan had a value of $35.7 million and a gain of $3.5 million for a return of just under 11%. It was an exceedingly strong period for the capital markets, driven by the outcome of the election, and especially, really the game changer was the release of the data related to the COVID vaccines, the effectiveness of it, and the fact that it was rolling out. So the market had a very strong fourth quarter. You also see through the 1 year period we've been working with you, very strong equity returns, 15.5%, a gain of $4.8 million. Jim highlighted at the beginning of the year how important that was for that asset allocation shift and being able to increase your equity allocation. That was very, very positive for the pension plan. Taking a look on page 5 at the various asset classes within the pension plan, equities, fixed income, and real return assets, you can see the performance in the fourth quarter for the asset classes was in some ways different than what we had for the full cumulative year in 2020. You see the S&P 500 was up 12.15%, which is a very nice return, but the overall equity allocation performance was 16.3%, driven by outsized performance in the Russell 2000 at 31.37, which is small cap stocks, and even mid cap stocks. The S&P 400 outperformed large cap at 24.37. And emerging markets did exceedingly well as well. So you see this rotation in the capital markets from the large cap growth stocks that have been the leaders really over the last 2 years. So that was a very interesting change and a changing dynamic within the capital markets that we have seen continue so far into January, and the portfolio for the pension plans are up again in January. Looking at the equity allocation and performance for the full year, 13.47%. Large cap stocks did outperform just about every asset class but the Russell 2000 during the year, and you end up with a very nice performance that way for the full year. Taking a quick look at fixed income on the next line down, 0.62% in the quarter, but you still have the effects for the full year of 6.31%. Very strong returns out of fixed income as interest rates dropped at the beginning of the year, at the beginning of the pandemic, from the fear of the lockdowns as well as the reduction in interest rates from the Federal Reserve. Real return assets, these in the fourth quarter are just the inflation-protected securities. And you'll notice the performance of 1.57%. We see some outperformance from the real return assets, the TIPS in the portfolio, compared to nominal treasuries as well as some of the other bonds within the overall bond market. And that's really fueled by rising inflation expectations within the capital markets, given the stimulus that the federal government is going to be providing over the next several quarters, as well as just general rising inflation due to the stimulus that's already been in the economy over the past year. So that's another interesting trend that we'll be watching throughout the year. And then you had a very good performance for the overall real return assets for the year as the capital markets recovered. So that's a very broad look at performance in terms of the portfolio for the non-salary DB plan. In the interest of time, I am not going to run through the performance for the salary plan or the Utica plan because the allocation is exactly the same among all 3 plans. And as you see from the performance report, the performance is very similar as well. So allocation and performance the same. Unless there are any questions related to performance, I'm going to pass it off to Jim, and he's going to be making some broad comments about the overall capital markets.
I don't think there's any questions on the performance. Just wanted to put you on warning that we're expecting the same thing for this year, though.
Yeah, well, let's hope we don't have to go get it the same way we got it last year. That was quite the ride. So yeah, it's great to be off to a good start with you, and you know, it is so important to meet your actuarial return objectives. We recognize that. Again, just to follow up with what we have mentioned a couple times, the asset allocation move that you embraced at a very difficult time to embrace it when the markets were not going in the right direction. That was a very good move, and certainly a great move last year, but that will pay both figuratively and literally dividends for years to come. So yeah, just to the fourth quarter overview, we're not going to talk much about COVID. You're all reading about all the things that have happened. You all understand some of the logistics issues that we're dealing with. But from an investment standpoint, this is really the 800-pound gorilla. Because we won't be able to open up the economy the way it used to be until we have a very high percentage of our population is vaccinated. And so that it is a little frustrating. We all have to be patient, but we're certainly moving in the right direction. And you're also well aware that there's more help coming. It looks as though the J&J vaccine is going to be approved. We're going to get the results of their clinical trials in the next week or two, and it will probably be approved quickly, assuming those numbers are good. And there's also the AstraZeneca vaccine, and both of those would be extremely helpful if they're near the efficacy of the Pfizer and Moderna vaccines. They'll be extremely helpful in getting the pandemic in check. Could you go to the next slide, please? So if you go to the bottom of that slide, Tim, scroll down a little bit. Yeah, just so you can take a look at the fiscal response. You know, what's happening not just in the United States, but around the planet, is governments have been stepping in to do the same thing outside of the United States as we are in the U.S. Clearly, there have been many people that have been inordinately impacted from an economic standpoint, the great loss of jobs that have occurred not just in the U.S. but elsewhere, and the ramifications that are associated with that, both economic ramifications as well as social and psychological ramifications, and non-pandemic health-related issues that are associated with that. So all of those factors, and that's not at all a complete list that I just went through, are hugely impactful as it relates to future returns in the capital markets, future corporate earnings, economic behavior, consumer confidence, and whatnot. So we have to keep a close eye on that. We're clearly I call it I'm hoping it's a speed bump that we're addressing right now in the United States and elsewhere, and that it's a speed bump and not that the bridge is out. Because if things go according to the way it looks as though they're going to go, we should be in pretty good shape come the summertime. And the stock market, I think, is safe to say, while it's mulling over the short-term ramifications of this speed bump, this pullback, this current reduction we're having, I think relatively shortly we'll look beyond that and get back and have a more positive view of the corporate earnings opportunities and the interest rate environment as they unfold later in 2021 and 2022. Next slide, please, Tim. So You saw the numbers yesterday, about 900,000 people in the United States applied for unemployment benefits. It's not a very good number. Employment data had been pretty good up until just the last few months. December, things seemed to come to a screeching halt. Actually were negative, their net job losses in December. It wouldn't be surprising if that happened this month as well, and perhaps into February. Beyond that, though, it's very likely that things will begin to open up. It's just a question of how quickly they open up, and you're likely to see the employment data improve. If you go to the bottom of the slide, Tim, I'm not sure if everybody can see if we're all looking at the same thing or not, but looking at the labor force participation rate, this is something that's likely, it has always been a lagging indicator, not a leading indicator, but it's likely to not look so favorable for a while. And so there are a large number of people who have taken themselves out of the job market because they're concerned, they just don't feel there's a job available for them. It's likely that we won't see the participation rate move up dramatically until we get an unemployment rate that's below 5%. And it may take a while to happen. Next slide, please. So we always look at consumer confidence, and if you could go down to the bottom of that slide, Tim, the personal savings rate. Why is that so important? It's because almost 70% of U.S. economic activity is based on what you buy and what I buy. And when do we buy things? We buy things when we're confident that things are going to be better in the future. That would mean generally that we have a job, and we feel confident if we were to lose our current job that we could get another one. That's the first thing. The second thing is we need to have some income that we can spend. And so disposable income is a very important statistic to look at in addition to consumer confidence. So consumer confidence has waned a little bit, not surprisingly, but it hasn't collapsed at all. And savings rates is up, and I think you're going to see a bump in this again with the most recent stimulus package. So when we do come out of the other end of this pandemic, consumers are very likely to unleash a torrent of spending, and that should have a very favorable impact on gross domestic product. The consensus thinking right now is about I think it's 4.2%, might be 4.3% increase in GDP 2021 over 2022. Some economists have numbers considerably higher, some as high as 6%. So, but it should be a good year economically in the latter half of 2021 and into 2022. Next, please, Tim. Housing has been great. Oh, let me pause for a second. Any questions at this? Okay. So housing has been very robust, and a lot of different ways of measuring it. There's also a lot of different metrics that we look at to give us an idea of where it's going to be heading, where are we going forward. And in both cases, the things look great currently, but also it's a very sanguine outlook for housing in the U.S. in particular. All of the reasons that you've been hearing about and reading about are valid. People moving to single-family dwellings, moving out of the city into the suburbs. There's not a lot of inventory out there. It's happening in central New York. It's happening in upstate New York. It's happening across the country where there is nowhere near the inventory available of existing homes to meet the demand. So that is a good indicator that housing pricing will be stable, if not better. The second thing to look at is home builder sentiment. We showed you that data in the last review, but home builder sentiment is the highest it's been since they started tracking the data back in 1985, and that's a great indicator of continued strength for the housing sector, which is a gigantic component of U.S. GDP, not just for the housing itself, but for all of the other related purchases that occur when someone buys an existing home or certainly when they build a new home. Next slide, please. Tim mentioned that the Federal Reserve is going to keep interest rates lower for an extended period of time. They're saying until they've seen dramatic improvement in the employment data. That may take quite a while. They're suggesting that they may not change the Federal Reserve rate, which is the rate that they charge their member banks, the federal banks. They may keep it at their current rate, which is 0 to 0.25%, into 2023, which would be quite amazing. They have had an influence, a significant influence on intermediate and longer term interest rates as well through their open market transactions. The Fed is out there buying $120 billion a month in mortgage-backed securities and treasuries, and that is keeping intermediate and longer term interest rates lower. But if you go to the bottom of the slide here, Tim, you'll see the yield curve there. The orange line is where we are, where we were just a couple months ago, and the black dotted line is where we were 6 months ago. And so you can see that there has been a steepening of the yield curve. And so the Federal Reserve, while it's had an impact, it hasn't been able to completely keep things in check. And if you look away from treasuries and you look at other parts of the bond market, you'll see a more dramatic impact. So the bond market is really going to do its own thing. The Treasury, the Federal Reserve, I should say, is going to have an impact on it, but it's not going to be able to control interest rates. So if inflation really does increase quite considerably, which is a possibility, although unlikely in the very near term, but over the next 2 to 3 years, if it were to increase considerably, you'd likely see a very big change to what this yield curve looks like, where you would see the orange line having a much steeper slope than it currently does, and going considerably higher than where the blue line was a little more than a year ago at the end of 2019. That, by the way, as a double-edged sword. Banks and financial services companies, a lot of cyclical businesses. Those would be environments where the economy is growing faster. Those stocks, many of whom have been laggards, will perform well in all likelihood in that environment. And it probably will be a tougher time for the stocks that Tim referenced earlier, those large cap growth stocks, those large cap technology stocks probably won't do as well. Next slide, Tim. Just briefly, the dollar, which is, this only goes back a few years, but the dollar has been very strong over the last decade up until just recently. We're seeing a drop. What are the ramifications of that? Well, they're twofold. One, as it relates to your portfolio, when we convert foreign earnings and foreign stock prices to dollars, the numbers will be greater, so that would be a favorable environment for that part of your portfolios. From an economic standpoint, it makes it's good for U.S. exporters because they can export at stable pricing, stable U.S. dollar pricing, or I should say when they convert back to U.S. dollars after the export is made, they're getting more dollars, and so it's a favorable thing for U.S. corporate profitability as well. Next slide, please, Tim. So the phenomenon that we were just discussing in the U.S. is actually global in nature. If you go to the bottom of that slide, Tim, you'll see that looking at both the services sector and manufacturing sectors outside of the United States, the projection is the current positioning is favorable. This is survey data where in this case, the World Bank is going out and surveying people who are running both service-based businesses and manufacturing businesses and asking them for whether they feel their business is going to expand or contract in the near future. And so when it's above that pink shaded line, that's a period of expansion. And so again, even though right now we're going through a tougher time, we would expect in relatively short order, hopefully by the time we meet next, that you'll see things turn even more positive. Next slide. So this just briefly, if you can just go down a little bit more, Tim. Yeah, so what you're seeing here is different parts of the market and how they're priced relative to historic averages looking over the last 20 years. And what's happened here is people say, gee, the market is very frothy, the market's very expensive. It depends on which parts of the market you're looking at. Some parts of the stock market are very highly priced. Technology stocks, consumer products companies, businesses, services that have been beneficiaries of the pandemic and the lockdowns, and those stocks are trading at incredible multiples relative to their earnings, if they even have any earnings in some cases. The rest of the stock market, though, is not that expensive, and in fact, what this chart shows, it's pretty much valued in keeping with its 20-year averages. What you can see here, if you can see the whole slide here, is the black dot represents current valuations and the blue square represents the average valuations for these parts of the market, over the average being over the last 20 years. So it's a longer term time period. And you'll see where the large and the growth parts of the market, where the black circle is at the peak of the bar, that's an indication really that their new highs are being established up until just recently. If we go to the next slide, Tim, actually keep going. I'm running out of time here. One more. This slide here. So Tim talked about the market rotation. And so what's happening is there's a, can you scroll down just a little bit more, Tim, for me? I can't, yeah, thank you. So what you see here is the market looking at on a capitalization basis, so large stocks versus medium size and small, based on their market capitalization, value versus growth, and then U.S. versus non-U.S. stocks. And in what we're showing here, if you have a chance to look at this later on, is really a very dramatic statistical change, a dramatic turn of events, where the parts of the market that have been so strong over the last few years, again, large growth stocks, U.S.-based growth stocks in particular, that's been by far and away the best performing part of the stock market. We're seeing it move away from those large companies into medium and smaller companies and into value stocks. We're seeing less interest in U.S.-based businesses and more interest in international businesses, particularly as it relates to large capitalized companies. And so your portfolio is designed, as Tim, the phrase he used was broadly diversified. So one of the things that, when we talk about what does diversification means, and I say this to you somewhat in jest, but also it happens to be true. One way of defining diversification is that there's always going to be something in your portfolio that you don't like, if the portfolio is properly diversified. And so, if you were a client of ours in 2019, you would have said, well, you may not have said this, but you might have been thinking, boy, it's too bad they don't have more money in the large cap growth stocks, because we would have had better performance, because Alesco has exposure to value stocks and non-U.S. stocks and smaller company stocks. So now here we are, a year later, and now we might be saying in a few months, boy, I wish they didn't have as much exposure to large cap growth stocks in the portfolio, because the value stocks are doing better and the smaller company stocks are doing, and emerging markets are doing better. But that's what diversification does. And the whole idea here is to not have everything going up and down at the same time, to smooth out the returns, and that allows you to manage this process better. And I'm a minute over. Well, I will see if there are any questions.
Are there any questions for Jim or Tim? All right, thank you, guys.
Thank you. Job well done.
Thank you. Thank you very much. Look forward to seeing you in a few months.
Yeah, guys, before you go, just as a discussion point, during our Audit and Finance Committee meeting later this morning, there's going to be a motion to make a maximum contribution to the pension So, our normal planned contribution would have been around 3.3, just a little over 3.3 million. We're gonna ask the board to authorize, up to 6 million, so it'll be an additional 1.6. So you'll be seeing that, hopefully it's approved, and if approved, you'll be seeing that, shortly.
Oh, great. Thank you for the contribution. We'll get it, just so you know, we when the money comes in, we put it to work right away, because of the long-term nature of the portfolios. So, thank you for the contribution, and, we'll do the best with that money, just like the rest, to help you get the job done.
All right, great. Thank you.
Thank you.
Thank you.
Thank you. And so that concludes the pension